Welcome to the research desk. Picture this scenario. It is the second week of March 2009. The S&P 500 has plummeted to 676.
Right, which represents a catastrophic 57% drawdown from its October 2007 peak.
Exactly. Across the financial landscape, retail investors are capitulating, pulling $25 billion out of equity funds in a single month. Every instinct in the human body, every macro headline and every conventional economic indicator is screaming at you to liquidate your portfolio and hide in cash.
Yeah, it's the agonizing dilemma every investor faces at a major market turning point. You observe the data, you suspect you are looking at a generational buying opportunity, but you lack a systematic, mathematical framework to convert that regime identification into precise position sizing.
But during that exact week in 2009, beneath the surface of the panic, a silent mathematical alarm was going off. We call it the March 2009 cognitive gap. You had price entropy sitting at the 8th percentile, while volume entropy sat at the 72nd. That is a positive 64-point divergence in entropy. It was the conviction meter basically screaming that the consensus was wrong.
So we are exploring the system that caught that signal.
We are. My position is that fusing a three-state Gaussian hidden Markov model with Shannon entropy compression and Kelly criteria sizing creates a mathematically rigorous architecture that fundamentally reshapes return distributions. This isn't theoretical. It's evidenced by a 12.8% compound annual growth rate and a 0.85 Sharpe ratio over a 26-year period.
Well, I take the opposing view. While I readily acknowledge the mathematical elegance of combining those distinct statistical disciplines, I intend to stress test this framework. I will demonstrate that real-world frictions, specifically an 11-day detection lag, a dangerously small 4-event sample size for its major signals, and the meta-risk of reflexivity threaten its theoretical alpha.
I think to really understand the architecture of this conviction, we have to unpack the framework itself before we dive back into that March 2009 moment. We are discussing a unified 2x2 conviction matrix designed explicitly to eliminate gut feel.
Right, taking human psychology entirely out of the equation.
Precisely. And the architecture relies on three highly distinct mathematical components. The first is the hidden Markov model, or M. For those navigating this space, think of the M as an algorithm that attempts to deduce the hidden state of the market, based purely on the visible clues it leaves behind in price action.
Sort of like deducing the weather outside by only looking at whether people in the hallway are carrying umbrellas.
That's a perfect analogy. It classifies the market into three distinct regimes: bull, flat, and bear. But more importantly, it calculates the persistence probability. That's the mathematical likelihood that the market will remain in that specific regime tomorrow.
Let us pause and clarify the second component, because I think this is where the framework becomes highly unconventional. You are pulling Shannon entropy directly out of the field of information theory, and you're applying it to market data.
Yes, exactly. So Claude Shannon developed entropy to measure the predictability of a signal in telecommunications back at Bell Labs. We are taking that exact mathematical concept and applying it to daily logarithmic returns.
Measuring the distribution.
Right. We measure the distribution of those returns over a rolling 60-day window, and then we rank them against a trailing 252-day period. This allows us to quantify what we call information compression.
So you're looking at how tightly clustered the market's behavior is.
Exactly. We categorize this market environment into three states. A compressed state means the entropy is in the bottom 20th percentile. A normal state encompasses the 20th to 80th percentiles. And a chaotic state represents anything above the 80th percentile.
And the third component is the synthesis of those first two, right? The actual output.
Precisely. The intersection of the hidden Markov model's regime probability and the Shannon entropy dimension maps directly to specific fractional Kelly bet sizes. John Kelly developed his criterion to determine the optimal size of a series of bets to maximize long-term wealth growth.
Which Ed Thorpe obviously popularized in blackjack and then quantitative finance.
Exactly right. So by systematically modulating how aggressively we express a regime call based on this matrix, The framework compresses the maximum portfolio drawdown from a devastating negative 56% under a passive buy and hold strategy, all the way down to a highly manageable negative 18%.
That's a massive reduction in volatility tax.
Massive. Furthermore, it elevates the win rate on completed trades to 71%. We are mapping mathematical conviction directly to capital deployment. It's not just elegant, it is empirically dominant.
Well, look, I want to grant you the quantitative high ground on the theoretical design here. Combining Robiner's work on Markov models, Shannon's information theory, and Thorpe's fractional Kelly implementation, it is structurally brilliant. But I must pivot immediately to the structural vulnerabilities.
Go ahead.
The core objection begins with how this system is trained and parameterized. You are citing a 26-year track record, but the framework relies on parameters estimated over that entire sample. That introduces a severe look-ahead bias.
I mean, we use Bayesian updates to...
But wait, in a historical backtest, your algorithm knows exactly where the boundaries of the 2008 financial crisis or the 2000 dot-com bubble sit because it has seen the entire data set. In live application, you do not have that luxury. The future is entirely unwritten.
I concede that look-ahead bias is the perennial enemy of quantitative backtesting. But, as I was saying, the framework accounts for this by utilizing real-time Bayesian updates. It only uses the data available up to that specific day to calculate the forward probability. It doesn't peek into the future.
But that Bayesian updating is exactly what creates the fatal flaw. Real-time Bayesian updates introduce an average 11-day lag in regime classification. The model requires sufficient new daily data points to mathematically alter its probability state from bull to bear.
It takes time to overcome the prior probability, yes.
Right. And 11 trading days is an absolute eternity during a liquidity crisis. That is a 2-week window in which catastrophic, portfolio-destroying losses occur. We saw this vividly in February 2020. Furthermore, the historical perfection of your ultimate structural break signal, the anchor failure, which I know we will dissect shortly, relies on a dangerously small sample size.
4 events.
Exactly. You are building a foundational risk architecture on 4 major events across a quarter century. 4 observations do not constitute statistical significance. That makes the entire framework profoundly fragile when facing future market shocks driven by entirely novel mechanisms.
Look, I see the vulnerability you are pointing out regarding the lag, but I want to build the context of why the redundancy in this system protects against that exact fragility. Let us move directly into the ultimate manifestation of the framework in action, that specific week in March 2009.
Okay, let's look at the actual mechanics of the cognitive gap.
Right. So we must break down the metric we call the cognitive gap. This is calculated very simply. It is the 60-day price entropy minus the 60-day volume entropy.
Let us ground that mathematically for the listener, though. What exactly is price entropy and volume entropy in this specific context?
Sure. Price entropy measures the dispersion, or the chaos, of the daily price returns. In March 2009, price entropy had compressed all the way down to the 8th percentile.
Meaning 92% of historical periods had more varied price action.
Exactly. In practical terms, this means the distribution of daily returns had become incredibly narrow and uniform. The market was characterized by grinding, highly correlated daily losses. The information environment regarding price was entirely compressed because every single market participant, from retail to institutional, had agreed on one central thesis. The global economy was collapsing. There was zero disagreement in the price action.
And the volume entropy?
Volume entropy measures the diversity of the trading volume across those exact same days. While price entropy was sitting at the 8th percentile, volume entropy registered at the 72nd percentile.
So volumes were chaotic.
Wildly diverse and chaotic. We saw sporadic, massive institutional block trades, punctuating days of totally exhausted retail capitulation. The mathematical gap between these two metrics, the price consensus versus the volume chaos, was a positive 64 percentile points. This is the cognitive gap. This divergence was the quantitative conviction meter screaming that the consensus was entirely wrong.
And this is where you apply the triple confirmation mechanism.
Yes. So, We had the 64-point cognitive gap. We combined that with a metric called transfer entropy, which spiked from 0.12 to 0.38 bits.
Stop there for a second. Transfer entropy is a dense concept. Explain the mechanism behind that spike. Why does a shift from 0.12 to 0.38 bits actually matter?
Okay, so transfer entropy measures the directed flow of information between two time series. It essentially asks, is Series A predicting Series B, or is Series B predicting Series A?
Who is leading the dance?
Right. Think of it like looking at footprints in the snow versus watching the wind blow the snow. Are the footprints dictating where the snow goes, or is the wind? In normal markets, price often drives volume. People see a stock going up, so they trade it. But in March 2009, the transfer entropy spiked to 0.38 bits, flowing from volume to price.
Which mathematically proved that directional institutional volume flow was driving price discovery.
Exactly. The smart money was accumulating aggressively, dictating the eventual price reversal. Finally, the hidden Markov model transitioned to a bull regime with a 0.87 persistence probability. This triple confirmation, the cognitive gap, the transfer entropy spike, and the M regime shift, justified maximum conviction. It mapped directly to a full Kelly allocation precisely when human psychology demanded total liquidation.
Okay. It's a compelling picture, I'll give you that. It's a beautiful mathematical symphony when applied to 2009. But I want to challenge the modern application of that specific sequence.
How so?
We must look at the profound shift in market microstructure over the last 15 years. The mechanics you just described rely heavily on the volume entropy signal. In 2009, dark pools, private exchanges where institutional investors trade away from the public eye, they handled roughly 16% of total trading volume.
Right.
The public tape, the lit exchanges, still captured the vast majority of the institutional footprint. Today, the landscape is entirely inverted.
You are referring to the fragmentation of off-exchange volume.
I am referring to a massive structural blind spot in your data. Off-exchange trading currently accounts for roughly 48% of United States equity volume. Nearly half of all shares change hands in environments specifically designed to obfuscate institutional intent.
Well,
So my question is, how can volume entropy reliably track institutional divergence when such a massive percentage of the volume is fragmented across dark pools, algorithmic internalizers run by market makers, and high-frequency delta hedging by options dealers? The volume data you are feeding into the Shannon entropy calculation today is structurally incomplete.
That is a fundamental challenge to the data architecture, I agree. But I must explain why the mechanism still holds. The fragmentation of volume into dark pools does not eliminate the informational value of the lit tape, it merely changes the baseline.
How so? I mean, if half the volume is invisible, your entropy metric is analyzing retail noise and algorithmic exhaust. It renders the cognitive gap misleading.
because dark pools are not entirely disconnected from the lit exchanges. Institutional algorithms eventually must interact with the lit markets to source true, deep liquidity, especially at major cyclical turning points. They cannot execute a multi-billion-dollar regime shift entirely in the dark without moving the public tape.
They leak information.
Always. Furthermore, entropy measures the diversity of the distribution, not the absolute magnitude of the volume. We are not looking for the total number of shares traded. We are looking for the chaos in the distribution of those trades. Even if 48% of the volume is off-exchange, the remaining 52% still exhibits the mathematical signature of institutional divergence. The footprint remains visible to the entropy calculation.
That assumes the behavior of the remaining 52% mirrors the hidden 48%. With modern algorithmic execution breaking massive block trades into thousands of microtransactions over a full trading day, the volume entropy on the lit tape might appear artificially compressed. It could completely mask the institutional activity you are trying to detect.
Matt is a fair point regarding algorithmic execution, which is exactly why the framework does not rely on the volume signal in isolation. We must shift from the specific event of 2009 to the day-to-day operation of the 2x2 conviction matrix itself. This matrix explicitly addresses the noise and data distortion you are concerned about. We need to understand the frequency and the underlying power of the maximum conviction state.
All right, let us define the exact parameters for maximum conviction.
The maximum conviction state requires 3 precise simultaneous conditions. First, the must declare a bull regime. Second, the Shannon entropy must be compressed, meaning it falls below the 20th percentile. Third, they must calculate a persistence probability above 0.85.
Which is a very high bar.
Because these criteria are so incredibly stringent, this state fired only 11 times in the entire 26-year data set. It is exceedingly rare. But when it fires, the average forward 6-month return is a positive 19.3%.
And what happens when those pristine conditions are not met?
The matrix dynamically protects capital by contrasting maximum conviction with the standard conviction state. If the M detects a bull regime, but the entropy is chaotic, meaning above the 80th percentile, and the persistence is below 0.60, the matrix recognizes the instability. It dynamically scales the portfolio exposure all the way down to a quarter Kelly bet, or even moves entirely to cash.
So it pulls back.
Exactly. The framework does not require the volume signal or the price data to be perfect every single day. It simply requires the information environment to be highly compressed and mathematically certain before it allows maximum capital deployment.
The elegance of that matrix on paper obscures the lethal reality of latency in live markets, though. Let us bring in the rigorous academic work on this subject, specifically Nguyen's 2018 study on real-time regime classification. Nguyen proved mathematically that real-time hidden Markov model classification lags the true regime shift by an average of 11 trading days.
I acknowledge the latency. It is an inherent property of Bayesian probability.
But let us apply that 11-day lag to the devastating reality of the COVID-19 crash. In late February 2020, the market structural breakdown was practically instantaneous. Because of the 11-day latency, the M component of your conviction meter would have still been flashing a bull regime.
Initially, yes.
Depending on the entropy readings, the matrix might have suggested an elevated or standard allocation, perhaps a half Kelly position while the S&P 500 was already an absolute freefall. The mathematical system would actively encourage the portfolio manager to hold significant long positions that immediately went deep underwater.
You are isolating the hidden Markov model from the rest of the framework. The entire premise of the matrix is triple redundancy, which explicitly limits the damage of the latency you just described. The lag absolutely exists within the M component, as you noted. That is a mathematical fact of Bayesian updating. The algorithm needs to observe enough lower prices to mathematically confirm the regime has changed. However, the Shannon entropy compression acts as the independent early warning system.
Walk me through how entropy solves an 11-day price lag.
We can look to the 2022 research by Sternschiss and colleagues, which modeled these exact conditions. Their research demonstrated that information entropy dropped below the 15th percentile 4 full weeks before the COVID crash began in earnest. The information environment became highly compressed well before the price action broke.
Meaning the market was getting dangerously quiet and correlated.
Exactly. The distribution of returns became tightly clustered. Therefore, while the M still read a bull regime in early February, the rapidly compressing entropy would have pulled the conviction matrix out of maximum and into a highly defensive fractional posture long before the 11-day price lag could destroy the portfolio.
So the systems cross-check each other.
Yes, the redundancy is the protection. The system requires agreement across dimensions. When the dimensions disagree, the Kelly criterion mathematically chokes off the capital allocation.
I accept the redundancy argument for that specific instance. But we must highlight the parameter risk associated with how you calculate that entropy. Your entropy percentiles are ranked against the trailing 252-day window. That is one trading year. If you apply this framework to a decade, like the 1990s, which was characterized by steadily declining volatility and persistently low entropy, your baseline becomes deeply skewed.
You are arguing that the model becomes desensitized.
Precisely. If the baseline entropy is exceptionally low for an extended period, a minor reversion to the mean might register as a chaotic spike. Or conversely, it might trigger false maximum signals during exogenous shocks, like the 1997 Asian financial crisis. In quantitative modeling, parameter sensitivity is the absolute enemy of robustness. If you change the ranking window from 252 days down to 126 days, the conviction readout shifts wildly. We are talking about altering the recommended position size by as much as 25% simply by changing the look-back horizon. A system so highly sensitive to its look-back parameters is structurally brittle.
The parameter sensitivity is a valid critique, which leads us directly to the system's ultimate structural break alarm, a mechanism explicitly designed to override localized parameter noise. We call this anchor failure. Anchor failure defines the exact moment when a defensive posture turns into a structural evacuation of the asset class.
Let us dissect the mechanics of anchor failure. What actually triggers the evacuation?
It requires a dual condition to be met simultaneously. First, the price must break below the 200-day moving average. That is a traditional, widely accepted technical trend indicator. But we mandate a second condition. The 60-day information entropy must simultaneously spike above the 80th percentile.
Why that specific combination? Price below the 200-day moving average happens relatively frequently.
Because price breaking the 200-day moving average is often just a technical correction or a false breakdown. But when it is paired with entropy spiking above the 80th percentile, it means the break in the trend is accompanied by total informational chaos. The disagreement among market participants has violently expanded.
And what is the track record of that specific dual condition?
The historical hits for this specific dual condition are remarkable. It fired in September 2000, exactly 13 days before the dot-com crash violently accelerated. It fired on September 15, 2008, the Monday of the Lehman Brothers bankruptcy. It fired on February 24, 2020, the exact day the COVID selling began in earnest. And it fired on January 18, 2022, 2 weeks before the Federal Reserve's hawkish pivot initiated a brutal bear market. There have been 0 false positives in 26 years.
You are basically comparing this to a meteorological warning system.
Yes, compared to the Saffir-Simpson hurricane scale, the wind speed, representing the hidden Markov model, tells you that you are inside a storm. The barometric pressure, representing the information entropy, tells you if that storm is rapidly intensifying. Anchor failure is the equivalent of a catastrophic barometric pressure drop. It demands immediate and total evacuation, regardless of what the wind speed currently reads.
That is a phenomenal narrative, and the analogy is vivid. However, I must rigorously attack the statistical certainty you are projecting here. You are citing 0 false positives across 26 years, but you are basing that monumental assertion on exactly 4 events, 4 observations. In the realm of statistics and quantitative probability, 4 events do not constitute statistical significance at any acceptable confidence level. It is a sample size so extraordinarily small that it borders on the anecdotal.
I recognize that 4 events fail the standard test of statistical significance, but they represent the only 4 systemic structural breaks in modern market history. We cannot manufacture systemic crises to satisfy a p-value.
But that is exactly my point. The model is perfectly descriptive of the historical period you backtested. It curve fits the past 4 crises flawlessly. But it is potentially useless for a future shock. A future structural break might be driven by entirely novel mechanisms that the 200-day moving average and informational entropy relationship has never encountered.
Give me an example.
What happens in the event of an artificial intelligence-driven flash crash that occurs in milliseconds? What happens during a sovereign debt crisis in the United States Treasury markets that cascades into equities? What about quantum computing-enabled front-running? These are scenarios where the historical relationship you rely on may completely decouple.
The exact nature of the catalyst is irrelevant to the framework. Whether it is an AI flash crash or a sovereign debt default, human beings and algorithmic systems will still process that panic through price and volume dispersion. The entropy will still spike as the consensus fractures.
I disagree that the catalyst is irrelevant, especially when we introduce the meta-risk of reflexivity. This is perhaps the most dangerous element of quantitative modeling. If this framework is as powerful as you claim, and institutional capital adopts conviction-weighted Kelly sizing at scale, the signal inherently self-destructs.
Explain the mechanics of that reflexivity.
Okay, imagine a scenario where a massive amount of institutional capital is governed by this exact 2x2 matrix. The market is humming along in a bull regime with compressed entropy. Suddenly,
an exogenous shock occurs. The entropy spikes into the chaotic state above the 80th percentile. The matrix instantaneously mandates a mass exit from maximum or standard conviction down to a quarter Kelly or an all-cash position.
Which is correct, the system dynamically reduces risk.
But because the system commands a massive swath of capital, that coordinated algorithmic liquidation amplifies the exact drawdown the system is trying to avoid. The selling creates more chaos, which pushes the entropy higher, which triggers further liquidation mandates from the matrix.
You're comparing it to 1987.
Yes, we have seen this precise mechanical failure before. It perfectly mirrors the portfolio insurance disaster of October 1987. The risk management tool itself, designed to incrementally sell futures to protect against a downturn, became the primary catalyst for the catastrophic crash.
Let me challenge that premise. Reflexivity requires an absolute uniformity of execution. It assumes every participant using the model operates on the exact same look-back window with the exact same latency and executes at the exact same millisecond. But the market consists of participants operating across vastly different time horizons, liquidity constraints, and tax mandates.
But the clustering of behavior still occurs.
Sure, but the framework is not meant to be a monolithic algorithmic trigger wired directly to the exchange. It is a dynamic sizing guide for human portfolio managers.
Even as a sizing guide, if the underlying logic becomes consensus, the alpha decays and the structural risk compounds.
That is why, to truly test the robust nature of this mathematical framework, we must expand its application beyond highly liquid public equities, where reflexivity and algorithmic crowding are most prevalent. We must move into the illiquid, opaque, and highly fragmented ecosystem of private venture capital.
Applying a daily probabilistic model to an asset class that prices once every 18 months is a profound conceptual leap. I mean, how do you map a daily hidden Markov model to venture capital?
It requires a profound, counterintuitive inversion of the entire system. In liquid public markets, low information entropy in a bull regime is your maximum conviction buy signal. It means the trend is strong and the data is clean. In venture capital, low entropy in a bull regime is a definitive sell signal.
Walk me through the mechanics of that inversion. Why is consensus a sell signal in private markets?
We execute this by treating entire technological sectors as the M states. Instead of bull or bear, the states might be software, hardware, or biotech. We then measure deal flow diversity, meaning the dispersion of term sheets across various subsectors as our entropy metric. Let us consider the artificial intelligence boom of 2023 and 2024. In early 2023, the deal allocation entropy within the AI sector was sitting at the 85th percentile.
Meaning the entropy was chaotic. There was massive disagreement.
Total chaotic disagreement among venture funds. Should capital flow into massive foundation models like OpenAI? Should it go into vertical applications built on top of those models? Or should it fund the back-end infrastructure and compute optimization? The funds that utilize this matrix logic sized aggressively into infrastructure, making bets on companies like Databricks at a $43 billion valuation.
Because the sector state was hot, but the specific application was debated.
Right. They made those maximum conviction bets precisely when entropy was chaotic and the consensus was fractured. They vastly outperformed the consensus crowd that was desperately chasing foundation models like Anthropic at an $18 billion valuation.
Because the disagreement provided the mispricing.
Exactly. Now look at late 2024. The entropy collapsed to the 12th percentile. Every single venture fund on Sand Hill Road was chasing the exact same foundation model wrappers with identical term sheets. The disagreement vanished. The entropy compressed. In the public markets, that compression is a buy signal. In venture capital, it mathematically signals that the alpha has been completely priced away by the crowd.
I must concede that I acknowledge the elegance of this specific inversion. It addresses the liquidity and reflexivity problems incredibly effectively. When every venture fund is chasing identical term sheets, the entropy is extraordinarily low, and it is entirely true that the crowd has systematically destroyed the premium. The historical parallel here is actually pristine.
You see the same pattern in previous technological cycles.
Absolutely. We can look directly at Sequoia Capital's Scout program between 2010 and 2012. During that specific window, there was incredibly high entropy in the mobile ecosystem. There was massive institutional disagreement over whether the dominant platform of the future would be iOS, Android, or web-based mobile applications.
The matrix perfectly describes that behavioral divergence.
It does. That high entropy, chaotic environment allowed for contrarian, maximum conviction bets in companies like WhatsApp and Stripe. Sequoia made those aggressive allocations precisely while the broader consensus crowd was pouring billions of dollars into social gaming companies like Zynga.
And the sizing dynamics change as well.
Yes, furthermore, I agree that in this illiquid environment, the Kelly fraction shifts dramatically. A standard venture allocation might dictate putting 2 to 3% of a fund into a single company. But for a high disagreement early bull, maximum conviction bet, when the entropy is chaotic but the sector shows massive growth potential, sizing up to 8 or 10% of the fund becomes mathematically justified. By applying the framework to venture capital, you successfully demonstrate that the mathematics are measuring human behavioral clustering rather than merely curve-fitting public market price action.
The mathematics of human panic and consensus scale across all timeframes and liquidity constraints.
However, while the venture capital application is a brilliant extrapolation, my core structural concerns regarding the public markets remain completely intact. The 11-day lag in regime detection is a mathematical reality that will violently punish a portfolio during a sudden liquidity shock. The incredibly small, 4-event sample size of the anchor failure signal leaves the architecture dangerously exposed to unprecedented novel market mechanics, and the continuous distortion of volume data by off-exchange dark pools fundamentally compromises the cognitive gap metric in modern fragmented trading environments.
I see why you emphasize those frictions. And they are rigorous, vital stress tests of the model. But the true strength of the framework is exactly what allows it to survive those specific vulnerabilities. Graceful degradation.
Define graceful degradation in this context.
It is an engineering principle. This matrix is not a fragile, hyper-optimized algorithmic black box that shatters when one input fails. It is built on the premise of triple redundancy, precisely like the flight computers on a commercial aircraft. If the hidden Markov model is suffering from the 11-day latency during a sudden crash, the Shannon entropy metric acts as a rapid constraint on position sizing. You will not be caught holding a full Kelly position during that lag because a rapid compression or explosion of entropy will have already choked off the capital allocation.
The system actively throttles down before the primary engine fails.
Precisely. If the volume entropy is indeed structurally distorted by dark pool fragmentation, the HMM's persistence probabilities hold the line and prevent overcommitment based on a faulty divergence reading. And when ambiguity exists across the layers, when the market is simply noisy and unpredictable, the system structurally defaults to standard conviction, reducing exposure to a highly defensive quarter Kelly.
It minimizes regret.
Yes, by systematically reducing exposure during periods of low mathematical certainty, the framework mathematically minimizes regret across all possible future states. It replaces emotional gut feel, panic, and human hubris with a transparent 3-layer scoring system. The frictions you mention are real, but they are exactly why a robust, redundant architecture is necessary. It offers profound implications that merit continuous, rigorous stress testing across every conceivable asset class.
This is the research desk, officially signing off.